There's a strange pattern hiding inside modern financial advice. The people who follow the rules most carefully, steady investing, disciplined saving, diversified portfolios, often look the safest on paper. Their accounts grow, their charts trend upward, and everything suggests the system is working exactly as designed. But every so often, when markets shift or life changes direction, something unexpected happens. The same people who appear financially secure suddenly hesitate. Opportunities appear, decisions need to be made, and yet their money, despite technically existing, doesn't move. It's tied up, locked into structures that made perfect sense during stability, which raises a quiet question most financial advice never addresses. What if the strategy that's supposed to make you wealthy is also quietly limiting your freedom? Financially stable people usually believe they're doing the responsible thing. They invest consistently, they automate retirement contributions, they diversify their portfolio. On paper, the strategy looks rational, disciplined, even optimal. The numbers move upward over time, compounding quietly in the background. Advisors point to charts showing long-term growth. Markets historically trend higher. If someone simply stays invested and avoids emotional decisions, the system is supposed to work. In this framework, wealth becomes a mathematical exercise. Maximize returns, minimize fees, allow time to compound the results. By that definition, the safest financial position appears obvious. Stay invested, keep money working, let compounding handle the rest. But there's a small fracture inside that conclusion. It's subtle, and most people don't notice it until they experience it firsthand. Because while portfolios compound on spreadsheets, life rarely follows the same smooth curve. Careers change, markets fall, opportunities appear suddenly and disappear just as quickly. And during those moments, something strange happens. People who appear wealthy on paper often become surprisingly constrained. They have assets, but they cannot move. Their capital is technically there, but practically unreachable without consequences. That's where the quiet difference between wealth and financial control begins to appear. Many professionals in their 30s or 40s technically have a high net worth. They own index funds, they have retirement accounts, some hold property or business equity. Yet, if a meaningful opportunity appears tomorrow, or if circumstances shift unexpectedly, they may not be able to respond without dismantling part of their financial structure. Selling assets during volatile markets, triggering taxes, unwinding long-term investments, suddenly the flexibility disappears. The balance sheet says wealthy, but the operating system of their finances is rigid. Liquidity changes that equation entirely. Liquidity is rarely celebrated in financial culture because it doesn't look impressive. It doesn't produce dramatic returns, it doesn't generate exciting screenshots for social media. But liquidity creates something more subtle and far more powerful: operational freedom. The ability to act without friction, the ability to move capital without dismantling the rest of your system. Traditional financial advice tends to discourage this. Most guidance emphasizes constant deployment of capital. Idle money is described as inefficient. Every dollar should be invested, producing yield, compounding into future wealth. The assumption behind this advice is mathematically reasonable. Over long periods, markets trend upward. Inflation erodes purchasing power. Therefore, keeping money invested should maximize long-term outcomes. But that logic quietly assumes stability. And stability is not how real economic systems behave. Economic cycles repeatedly introduce instability. Interest rates rise, liquidity tightens, entire industries contract while others expand rapidly. These shifts rarely happen slowly. They tend to arrive abruptly, creating temporary gaps in pricing, employment, and business opportunities. During these periods, something fascinating emerges. Many people become financially paralyzed at the exact moment when the most interesting opportunities appear. Not because they lack intelligence, not because they lack income, but because they lack liquidity. When capital is fully deployed, it becomes difficult to reallocate quickly. Selling investments during volatility feels psychologically painful. Selling assets during downturns can lock in losses. Borrowing during uncertainty becomes expensive, so people hesitate, they wait. They tell themselves they'll act later, once conditions stabilize. But opportunities rarely wait for stability. This is where the concept of optionality becomes important. Optionality is not about predicting markets, it's about preserving the ability to respond. Liquidity creates optionality because it allows capital to remain mobile. When an undervalued asset appears, when a new venture requires funding, when someone wants to shift careers or relocate or invest in a new path, liquidity allows the decision to be made based on logic rather than constraint. Optionality is a form of leverage that doesn't rely on debt. Most people think of leverage as borrowing money to amplify returns, but operational leverage can also come from flexibility. A person with accessible capital can evaluate opportunities calmly. They can negotiate from a position of autonomy. They can deploy capital selectively rather than reactively. The difference may not appear dramatic in a single year, but over a decade it becomes structural. Because financial decisions are rarely made in perfect conditions, they're made under pressure, and pressure changes behavior. When people feel financially constrained, their psychological baseline shifts. Decisions that would normally be obvious become emotionally complicated. A job offer that requires relocation becomes impossible because the financial buffer isn't there. A business opportunity that requires temporary income volatility feels too risky. Even small financial disruptions, medical bills, job transitions, family obligations, can create stress that forces short-term decisions. Liquidity quietly removes that pressure. When accessible reserves exist, the emotional intensity surrounding financial decisions decreases. People stop reacting to every fluctuation. They stop chasing returns to compensate for fear. Instead, they begin thinking in terms of long-term trajectory. The focus shifts from maximizing consumption today towards controlling the conversion of labor into freedom over time. That shift alone could alter someone's entire financial identity. Because most people who earn good income still operate inside a fragile system. Lifestyle creep slowly absorbs every raise. Fixed expenses expand. The margin between income and obligations shrinks. Eventually, even high earners become dependent on maintaining their current income level. They look wealthy from the outside, but internally, their financial margin is thin. Liquidity rebuilds margin, not by eliminating investment or growth, but by restoring balance inside the system. Growth assets can still compound over decades, but a portion of capital remains accessible, waiting for moments when deployment actually matters. Think of personal finance as a three-layer system. The first layer is stability. This is the financial base that protects daily life from disruption: rent, food, healthcare, basic living costs. The second layer is strategic liquidity. Capital that remains accessible not for emergencies alone, but for meaningful decisions, career changes, investment opportunities, business creation, or geographic mobility. The third layer is long-term compounding capital, investments designed to grow slowly over decades. Most people attempt to operate with only the first and third layers. They cover their expenses and invest everything else. But the missing middle layer, the strategic reserve, is what creates optionality. Without it, every financial decision becomes reactive. With it, people begin behaving differently. They wait longer before deploying capital. They negotiate harder. They walk away from bad deals. They refuse roles that compromise their autonomy. These behaviors appear small individually, but over time, they accumulate to a dramatically different financial trajectory. Because compounding is not only mathematical, it is behavioral. The ability to remain patient when others are rushed creates advantages that compound quietly for years. Opportunities are evaluated carefully rather than impulsively. Investments are entered during moments of mispricing rather than excitement. Careers evolve intentionally rather than under financial pressure. This is where the psychological shift occurs. Wealth stops being defined by visible assets and begins being defined by control. Control over time, control over decisions, control over when and how capital is deployed. The goal subtly changes from looking wealthy to operating with autonomy. And once someone experiences that shift, the entire system of financial framework starts to look different. The long-term risk isn't simply inflation or market volatility. The deeper risk is structural rigidity. A financial life designed around constant consumption and constant deployment of capital can become extremely fragile during periods of change. And historically, economic systems experience those periods regularly. Interest rates shift, industries reorganize, entire technological revolutions reshape employment markets. The next decade will almost certainly contain disruptions that today's spreadsheets cannot predict. People who build flexibility into their financial structure will navigate those disruptions differently. They will not necessarily predict the future better, but they will be able to respond to it faster. And that difference often determines who converts economic change into opportunity and who experiences it as disruption. If you've been listening to this and something in your intuition feels validated, that's intentional. Many thoughtful professionals already sense that the typical financial playbook is incomplete. They follow the advice, invest diligently, build income streams, yet still feel financially exposed, not because they're irresponsible, but because the system they're operating inside prioritizes optimization over resilience. And that's exactly why this channel exists. Nick Finance isn't here to shout stock picks or push quick financial wins. The goal is something quieter and more durable, to explore the deeper systems that shape long-term financial autonomy, the structural decisions that determine whether income eventually converts into freedom or simply fuels a larger lifestyle. If these ideas resonate with you, take a moment to subscribe to Nick Finance, not because you need more financial noise in your life, but because building a clear financial philosophy requires repeated exposure to better mental models. Over time, the goal isn't just to accumulate more information, it's gradually to refine how you see money itself. The professionals who ultimately build lasting financial autonomy tend to share one trait. They stop thinking about money purely in terms of income or investments. Instead, they start thinking about systems, margin, optionality, control,